A few weeks ago, I did a video talking about the tax implications for commercial real estate. But you know, there are capital gains tax implications for residential homeowners. So that's what I'm talking about today. Stick around. Hi, welcome back. My name is Joe Brown. I'm a real estate agent with Century 21 List with Beggins, located in South Tampa. Thank you so much for being here with me. So, yeah, when you sell a house, hopefully you have a gain. And that gain can be taxed. So I want to talk about that. Right, so let's just start with a basic question, right? So you buy a house for $400,000 and you sell it for $300,000. So you have a loss. Well, the first question, can you take that loss off of your income tax? And the answer is no. You can't. It's kind of like buying a Peloton for $2,000 and selling it for $500. That's not a loss, right? It's just, it is what it is. Same thing with a house. If you sell the house for a loss, you cannot write it off your taxes. Okay? So get that question out of the way. But let's flip it around. You own a home, and let's say you buy the home at $300,000 and you sell it for $400,000. So you make $100,000. Do you pay tax on that $100,000? And the very simple answer is, it depends, right? So it depends on several things. One, is it a short-term or long-term gain, right? So short-term, if you've owned the home for less than a year, then that money is usually considered ordinary income, right? But there are some exceptions. And listen, here's a caveat to start the video with. All of these scenarios, talk to a tax accountant or a CPA for the final answer. I am not a tax advisor. I'm not giving tax advice. I just want to give an overview. So if any of these scenarios you think pertain to you, talk to a tax expert, right? But go back, if you own the home for less than a year, there are certain exceptions to which that money is not counted as a ordinary income, such as if your company moves you, or there are health issues, or special circumstances, right? So there are some exceptions, but again, talk to a tax expert about that. So that's short term. Now you look at long term. Long term is usually over 1 year. However, for the capital gains exemption, and I'll talk more about that in a second, you have to own the home and live in the home for at least 2 years. 2 of the 5 previous years, you have to own the home and live in the home. So let's say you own a home and lived in a home for 2 years and you sell the house. Well, then you are eligible for capital gains exemption. And the exemption is, if you're a single person, you can exempt up to the first $250,000 of capital gains. A married couple can exempt $500,000 of capital gains, right? So in the example I gave, you bought a house for $300,000. Let's say you sold it after 3 years that you've owned the home and lived in the home for $400,000. So that $100,000 would be exempt because it falls under the $250,000 or $500,000. But is what I'm saying really true? Because I'm saying you bought the home at $300,000 and you sold it at $400,000, so it's a $100,000 gain. Is that $100,000 really accurate? Well, the answer is no, because what you bought the house for, let's say, sets the base. But with that $300,000, you also had closing costs associated with that. So it may not really be $300,000. Maybe it's $308,000 or $310,000. And then I say you bought the house at $400,000. You sold the house at $400,000, but really there were closing costs associated with that. So maybe it's really not $400,000. Maybe it's $385,000. So the difference in gain is that $310,000 to $385,000. I hope that makes sense. But let's say during the course of the 3 years, you had to replace the entire roof, and that entire roof costs $10,000. Well, that goes to add to your base. So what I said was $310,000, now it's $320,000. Let's say you replaced the air conditioner unit, and that was $5,000. Well, that adds $5,000 to the cost, to the basis of your house. Does that make sense? So anything you do to add value to the house adds to the cost basis of your house. And it could be replacing the old windows with new hurricane impact windows, replacing the front door with a impact resistant door, replacing the entire roof, replacing the HVAC or heating system. If you had to change the wiring in the house, if you had to replumb the house, all of that will add value and add to the cost basis of the house, right? But let's say you had a window break, so you just had to come replace the window. That doesn't count. You just had a small area of the roof that needed to be patched. That doesn't count, right? So general repairs do not count towards the cost basis. But adding value to the house, the items I mentioned, adding a bedroom, adding square footage to the house, all that increases the cost basis of the house. So capital gains is really figured on what's your cost basis and what are you selling the house for, minus the cost of selling the house. So you have the sales price minus the cost of selling the house minus the cost basis of the house, and that gives you the capital gains. And again, you can exempt $250,000 or $500,000, depending on if you're single or married. Now, what if, and very sad situation, but it's common, what if married couple owned a home, they bought the home together, owned the home, and one of the spouses dies? So let's say in this case, the husband dies. So they bought the house at $200,000, and after 15 years, the husband dies. Well, the wife can sell the house and exempt the $500,000 if she sells the house. If she sells the house within 2 years of the husband's passing. After 2 years, she's considered a single person and can only exempt $250,000. Okay? So there is a time window when she can claim that extra $250,000 exemption. But her cost basis changes. So, and again, talk to a tax expert about this, but this is my understanding. They bought the house for $200,000. So each of them, husband and wife, has a cost basis of $100,000 for the house. 15 years later, the house has a fair market value of, let's say, $500,000, and the husband dies. Well, the wife gets 1/2 of the cost basis. So if the cost basis is now $500,000, half of that is $250,000, and you add that to her original cost basis of $100,000. So now her cost basis is $350,000. And then she could have the exemption above that, right? So the passing of a spouse is complicated. I know I went through it quickly. That's why I keep saying, go to a tax accountant, go to a CPA. They understand the tax laws. I'm just trying to present a general overview. But here's my recommendation. Keep receipts for all of the major work you do, whether it's a new roof, whether you're adding AC system, if you're adding on to the house, if you're redoing the electrical or the plumbing, adding a new water heater. Keep all those receipts, because all those receipts add to the cost basis of the house. If a spouse dies, try and get an appraisal at that point of what the house is worth. Because then when you go to sell the house and you need to justify the additional, 50% of the fair market value, you're going to be asked, how did you come up with this fair market value, right? So that's another suggestion. How about, here's a question, what if there's a senior? Let's say there's somebody 79 years old. Do they get an extra exemption? And the answer is no, right? Unfortunately. Now, years ago, they used to. But when the tax laws changed to the $250,000 to $500,000, they did away with the special senior exemption. So, as I've said a few times in this video, I just wanted to give a brief, quick overview for capital gains. I have met people that say, oh, I'll sell the house and just move on. And I would say in the majority of cases, that may be true. But in some cases, you will have to pay capital gains based on the difference between what you sell the house for minus closing costs minus your adjusted cost basis. And if it's over $250,000 or $500,000, you will have capital gains on that. What I did not talk about is if you own a home that you rent out. That's a different animal, because you have to go watch my other video where I talk about commercial properties, because you would have claimed depreciation and so forth. So I won't get into that. So I'm just talking about homes that you've owned and lived in for at least 2 of the past 5 years. And this is really came to mind because I'm working with somebody now, and she and her husband have owned the house almost 40 years. They bought the house for under $200,000 at the time, and now the house is worth over $2 million. So, unfortunately, the wife is facing a pretty substantial capital gains tax. So that's why I wanted to share this information. Know your situation, right? Talk to CPA, talk to a tax accountant. I hope you found this video informational and of value. Please share this with people you think need to know this information. Go to my website, both of them. So JoeBrown.live. You can search for homes. I have special blogs at the bottom of the page for just certain neighborhoods in this area. You can search for homes. I have custom searches set up. There's a mortgage calculator, whatever. But then my other website, which is JoeBrown.live, is my WordPress site for blogs. And I have a blog specifically on this topic, capital gains. Right. I think right now I have 65 blogs out there. You can search by category, search by topic. So I'm here. I want to be your trusted advisor. I want to bring value to you as a consumer, as a community member, right? So until next week, take care.